All right. Good morning. We don't have it's not a live trading day. It's just a trade recap post trading session just to talk through what I was looking at, what I saw, what I did. Um Today I lost my trade. Lost 900 something dollars, my lowest stop loss yet or in a while, which is great. Um but anyway, this is the trade I took today. We had news at 5:15. Um we had PMI at 7. It was right here. Um, so I took a short today. Um, and I'll go into why this was a bad idea a little later. But I'll just mark out my trade idea. So basically, what we got is I was looking for a liquidity sweep of a key level, and we got that. Right around here was London London high, and right around here was a 1 hour high. So I was looking to reverse off of that level and then go to the downside. And I had all of my levels marked out down here for my take profits. Um, so we come out, sweep those. I ended up drawing a 30-minute fair value gap, which was over here. I saw that it was respecting that. It's like, oh, cool. I'll just keep that there and use that as a confluence. I see some like PJ Trades, I think, and some other people they use like 15-minute and 30-minute fair value gaps as a respection point and a price area for price to drop back to and then come out of it. So I was thinking about using that, but also just kind of mainly for this pretty much first confirmation point. And so after sweeping those levels, um, I'm then looking for my 5-minute confirmation confluence, which we get in the form of on this candle we inverse this fair value gap, this 5-minute fair value gap. So I'm like, cool, looking for price to retrace back up, and we disrespect this fair value gap here. Here, I'll stop using that. We disrespect this fair value gap there. Right then I was kind of just sitting on the 1 minute, looking, seeing. Hold on, seeing this fair value gap being ran, this fair value gap being ran. And so at that point, there's no more fair value gaps on the 1 and 5 minute past this point. So that should have already told me, hey, let's not look for a short here. Um, but instead, at this point, I figured I'd use the 30-minute fair value gap as a retracement point, which could have worked. Maybe that was my thought. That I've seen people do this before. Again, one, I was taking a reversal model. I told myself I wouldn't take a reversal model. And then here I am the next day taking a reversal model. Um, so not great discipline there, but I had to learn. I had to do that today to learn a lesson. And I learned a very good lesson today, I'd say. So, which is very good. Anyways, as far as retracements go, we kept retracing higher and higher and higher. And at this point, I was like, I don't like using order blocks in this case because I don't know how to draw an order block in this area. Um, so like, well, fucking order blocks, breaker blocks are a no-go for me here. Fair value gaps have all been ran here. Um, I didn't really think about equilibrium, but obviously we're way past equilibrium here. Way past it. So at that point, I'm just using other people's ideas of like a 30-minute and 15-minute fair value gap and retracing back to this to then go lower. So retracement confluences, none of mine were hit. Buy promo tries out someone else's strategy. Bad idea. Never do that. Um, and then I'm looking for shorts where it's a solid uptrend on the 1 minute. And so I'm looking. I entered this trade off of this inverse fair value gap. I should have waited for a 1 minute break of structure, which was down here. We came down, didn't break structure, and just kept going higher. So I should have waited to see this low be put in and then see if we would come down and break structure below that low. But we didn't. So don't use inverse fair value gaps there. Use breaks of structure. Um, so that was another mistake I made. And then, like a couple minutes later, we get in. Well, then a couple minutes later, we get stopped out. This is. It was a bad day for me. I shouldn't have traded. This was a bad. I shouldn't have traded because of what I did. It was a bad day for me. Bad day psychology wise, bad day um, confluence wise. Because I came into the market saying government shutdown, I shouldn't be trading. And I got in. I was impatient today, maybe a little greedy, who knows. Not too fearful, but just impatient. It didn't really follow my word, but not beating myself up about it at all. I don't feel bad about it at all. I had to do this today to learn a really good lesson revolving around my strategy. So I'll do this. We'll get rid of this. Um, we'll go here. I can also get rid of here. I'll just get rid of all of this, and I'll go here. Bring this up. Um, the important lesson that I what start new. Yeah, what? Um, all right. So the important lesson that I learned today revolves heavily around strategy. I tried taking a reversal model today, which I told myself I wasn't going to use anymore. I'm just going to use continuation until I can um, practice the reversal model. So I didn't do well in that scenario. Um, and so looking at it, why does the reversal model not work for me? Well, it's because I know that, especially you can see it well on the 1 hour, the 4 hour, not so much. Um, on the 1 hour, you can see, no, what? Select bar, come on back, thank you. Um, on the 1 hour, you can see it well. Price always draws towards low resistance, high time frame liquidity. What is that? So on the 1 hour, we're on this solid uptrend. Here, let's go right here. We're on the solid uptrend. So in terms of liquidity, would it make more sense that we instantly reverse and come take out this liquidity? Or would it make sense that we continue our trend and take out this liquidity? So we come up here, we come up, take this out, take this out, take out this Asia high, take out this previous day high. Does that make more sense? Or does it make more sense that we instantly reverse and take out this, and this? We can and will take out this liquidity, but before that happens, we have to come out and take out this liquidity to then get the fuel to come lower. So this will happen, but not yet. First, we have to come out and take out this liquidity. And I know this, but for whatever reason, I came into the market today wanting to take, like, just staring at this sell side liquidity and knowing that it was high resistance. I knew this was high resistance at the moment, and it would become low resistance when we reverse off of one of these levels. But instead of me taking a trade up to these levels, I decided for some reason to try and predict whether it comes off this level and then goes down, or whether it would come off this level, then go down, or maybe it comes off Asia high and then comes down. Maybe it comes off previous day high and then comes down. I tried to predict which level it would reverse off of. That just, for me, probability wise, it makes more sense to trade to these low resistance liquidity levels and then take off some of my position here, then take off more of my position here, then take off more of my position here. That makes more sense rather than waiting to try and get the right entry and catch that big trade. It's greedy to try and think you're better than the market and think that you can predict where price is going to react off of and then catch a massive trade. That's greedy. So that's what I did wrong today. I should have looked to take a trade up to these levels. I should have. And then, because look what happens. Price does exactly that. Boom. It goes all the way to previous day highs. If I would have just taken this trade, I would have caught a, what is that? Let's just say from here, I don't know. That's a 100+ point trade. And then price gets to this level, and then I can be off the charts, and that's cool. That's all I need. Whereas if price were to open at this level, I'd be like, okay, damn, we should be looking to take trades to this low resistance liquidity, because now that we've passed previous day highs, I don't think it'll go any higher. I don't think we'll go up here. That's our next draw on liquidity. I don't think price will go up there. And now, because we will probably reverse off this level, all of this, I guess, all of this has now became low resistance liquidity. Whereas when I was on the market, this was low resistance liquidity. I should have been taking a trade up to these levels. So that's what I did wrong today. And that liquidity lesson is why I find success in the continuation model rather than the reversal. So that was the lesson I needed to learn today. I needed to be immature, impatient, greedy today and break my rules today so that I can learn that, so that I can learn this lesson and never make that mistake again. I have right here in my notes. Actually, I'm going to write that down in my trading journal too. What I learned today: only ever take a trade in the direction of low resistance liquidity. So, anyways, that'll do it for me. That's a trade recap. This is what I lost today. Guess I'll show you this. Might as well. First day of the month, lost $920. Risked my usual amount, but my stop loss was a little less because I was able to find a decent entry point. So my risk to reward was really good. so I didn't lose too much. But either way, still lost. So that is the lesson I had to learn. All right, see you.